Hello, and welcome to another Wyckoff Trading video. I'm Jim O'Brien. This video discusses short-term downtrends and how they can help Wyckoff students increase his or her short-term profits. Short-term trends last from a few days to a few weeks. During that period, the Wyckoff trader should expect to see a profit of between 20 and 30%. Because the markets are more orderly during downtrends, short-term downtrends are usually shorter in duration and have a wider price differential. The trend of the market, or an individual stock, is simply the line of least resistance. When, on a reaction, a stock meets opposition to its decline, it must either be strong enough to overcome the buying or it must inevitably turn up. It is vitally important that Wyckoff students always trade with both the trend of the market and the selected stock that matches their investment objectives. That means that if a trader is considering a short position for a short period of time, he or she would want their market index to be in a short-term downtrend. Then they would select a stock that is either in a short-term downtrend or experiencing ending action, like an upthrust, which would signify the beginning of a short-term downtrend. The same is true when trading for intermediate or long-term gains. They will be discussed in more detail on their own videos. Never, ever trade against the trend. It almost always leads to disaster. A short-term downtrend is established when a stock puts in a lower low that is followed by a rally to a higher high. Analyzing short-term trends requires a good understanding of support and resistance points as the stock either advances or declines. How a stock behaves as it approaches its trend channels, support or supply lines, can tell us a great deal about its future direction. An analysis of Lowe's Home Improvement Company, symbol LOW, is an excellent example of how the Wyckoff student can identify, take a position, and show a nice profit in a short period of time.
In early December of 2015, Lowe's completed a rally to point A on its vertical line chart. There, demand was withdrawn and the stock began to move sideways. The support and resistance lines that define the top and bottom of the sideways move are drawn in green. Lowe's moved sideways until it reached point D. Notice the rally to point D was on a lack of demand. In addition, the technometer moved into an extremely overbought condition. Even though there was no ending action in the form of an upthrust, it certainly appeared the stock would have a difficult time continuing its rally and most probably would begin some sort of a reaction. In addition, there was a count of 8 between points D and A on the point and figure chart. If Lowe's began to react, this would be a good place to take a short-term position to the downside. Stop orders should have been placed slightly above the highs at point A. The next day, Lowe's reacted, and then supply began to come into the stock as it moved through the support line drawn from point C and continued to decline. This was a sign of weakness. Then, volume and price spread decreased on the short rally to point F. In addition, Lowe's was unable to return to its sideways trading range. This suggests the move to point F was a last point of supply. If positions were not taken in the area of point D, they certainly could have been at point F. In addition, those who took short positions at point D could have added to them at point F. As point F was lower than point D and point E was lower than point C, a new short-term downtrend channel can be drawn. The supply line is drawn through points D and F. A parallel support line is drawn through point E. Back to the point and figure chart. A count can be taken from the last point of supply at point H over to point A. This is a count of 16 points, giving us an objective of between $56 and $62 per share. Lowe's reacted to point G, and met the maximum objective of the count taken from point D. At point G, Lowe's also weakened its short-term downtrend channel. In addition, the technometer moved into a clearly oversold condition. As Lowe's has met its first objective, orders could be closed and profits taken. However, it does appear to have more potential to the downside. This gives the Wyckoff trader an option to continue to maintain their positions. In that case, stop orders should be moved to slightly above point F. This will cover costs and ensure a small profit. The weakening of the trend channel suggests the stock still has some legs to the downside. The oversold condition suggests that before that happens, there will be some sort of rally. Lowe's did rally, but appeared to run out of demand as it approached the channel's supply line. Some supply appeared as the stock tested the supply line. This is not uncommon. Usually a stock in this situation will react back and retest the downtrend channel support line. However, things don't often go as planned. In this case, supply dried up at point H. This gave Lowe's another chance to rally, and the stock moved quickly to point I. Should the trade be closed? In this case, there are several reasons why the short-term position should be maintained. First, notice the reduced volume on the rally to point I. This suggests demand is not coming into the market just when it should be. In addition, Lowe's did not return to its initial trading range. That's why the trading range support and supply lines should always be extended. Finally, Lowe's is in an overbought position relative to its technometer. All these suggest it will be very difficult for the stock to continue its rally, and even though it has noticeably weakened its downtrend channel, there is reason to expect it to react and return to the short-term downtrend channel. That's exactly what happened. Supply came back into the stock, and Lowe's reacted sharply to point J. It slightly weakened its short-term downtrend channel. Its technometer reading became oversold. This suggests Lowe's is now ready to rally. At point I, the stock also reached an objective on its point and figure chart. $63 is the minimum objective on the count taken from point H. If a position was taken at point D, the Wyckoff trader would see a gain of 14 points. If the position was taken at point F, there would be an 11-point profit. The oversold technometer and the fact that Lowe's reached an important objective on its point and figure chart suggests this might be a good place to close positions and take profits. Then Lowe's rallied to point K. This noticeably weakened the short-term downtrend channel. The reaction to point L confirmed the channel was broken and the trend was changed from down to neutral. Any positions that were still open should have been closed in the area of point L. The entire move from point D to point J took just over 8 weeks and returned some excellent short-term profits. You can learn more about these profit-making strategies by reading our Wyckoff ebook called Wyckoff Strategies and Techniques. The book is an updated version of the Wyckoff course in stock market science and techniques. As a special bonus, a free audio recording of the ebook is included with every purchase. The audio recording has its own set of charts that make it easy to follow along as you learn more about these profitable Wyckoff strategies and techniques. Learn more about how to make better trades by using time-proven Wyckoff strategies and techniques by clicking the link below.